In the final weeks of 2025, a confluence of financial pressures has brought the United States to a critical inflection point, where the long-simmering vulnerabilities in its bond markets and the explosive growth of artificial intelligence infrastructure are colliding with profound consequences. Reports from mid-December indicate that yields on longer-term U.S. Treasury bonds have begun to rise sharply amid concerns over persistent fiscal deficits and investor skepticism about the sustainability of massive public borrowing. This upward pressure on yields, reflecting falling bond prices, has raised alarms that the era of easy money that fueled an asset bubble across stocks, real estate, and technology may be coming to an abrupt end. At the same time, the rapid expansion of AI-driven data centers, consuming electricity at unprecedented rates, has triggered warnings of impending power shortages and grid instability, prompting what industry observers are calling the beginning of a major panic among developers, utilities, and policymakers. This is the story of the reckoning that has arrived. Collapsing bonds threatening to pop the U.S. economic bubble, as a data center crisis exposes the limits of the AI boom. It is a narrative of overextension where low interest rates and technological optimism masked underlying fragilities, now laid bare in a moment of converging risks. To understand this reckoning, we must first establish the foundational concepts of bonds, bubbles, and the role of data centers in the modern economy, assuming no prior familiarity with these interconnected elements. Bonds are essentially loans issued by governments or companies to borrow money from investors. In return, the issuer promises to pay back the principal, the original amount borrowed, at a future date, along with periodic interest payments known as coupons. U.S. Treasury bonds are considered among the safest investments because they are backed by the full faith and credit of the federal government. They come in different maturities: short-term like Treasury bills less than a year, medium-term notes 2 to 10 years, and long-term bonds 20 to 30 years. The price of a bond and its yield, the effective interest rate an investor earns, move in opposite directions. When bond prices fall, yields rise, signaling higher borrowing costs for the issuer and often reflecting investor concerns about inflation, deficits, or economic instability. A bubble occurs when asset prices, whether stocks, housing, or bonds, inflate far beyond their fundamental value, driven by speculation, easy credit, or irrational exuberance. Bubbles typically burst when reality intrudes, such as rising interest rates making borrowing more expensive or revealing overinvestment. The U.S. has experienced several. The dot-com bubble of the late 1990s, fueled by internet hype, burst in 2000, wiping out trillions in stock value. The housing bubble of the mid-2000s, inflated by loose lending, collapsed in 2008, triggering the global financial crisis. Today, many analysts point to an everything bubble, where low rates post-2008 and during the pandemic pumped money into markets, driving valuations to extremes. Data centers are vast facilities housing thousands of servers, computers that store and process data for cloud computing, streaming, and now AI. AI requires immense computing power for training models on huge datasets and running inferences, generating responses. Data centers consume massive electricity for servers and cooling, equivalent to small cities. The AI surge has accelerated demand, with hyperscalers like Microsoft, Google, Amazon, and Meta investing hundreds of billions in new facilities. The background to this crisis traces back to the post-2008 era. The Federal Reserve slashed rates to near zero to stimulate recovery, keeping them low for over a decade. Quantitative easing, buying bonds to inject money into the economy, expanded the Fed's balance sheet to $9 trillion by 2022. This flooded markets with liquidity, suppressing yields and encouraging borrowing. Governments ran large deficits, especially during the pandemic, with U.S. debt surpassing $35 trillion by 2025. Low yields made treasuries attractive but also fueled risk-taking. Stocks soared, housing prices doubled in many areas, and tech valuations exploded on AI promises. Step by step, the events of 2025 built to this reckoning. Early in the year, yields hovered around 4%, with the 10-year Treasury at 4.15% in December, down from peaks but still elevated historically. The Fed cut rates 3 times in 2024-2025, but inflation lingered above 2%, tied to supply chains and energy. Trump's second term introduced tariffs and tax cuts, boosting growth but widening deficits projected at $2 trillion annually. Investors began demanding higher yields for long-term bonds, fearing inflation or default risk, though remote. By mid-2025, bond auctions showed weakening demand. Foreign buyers holding $8 trillion in treasuries slowed purchases amid dollar concerns and diversification. Domestic funds absorbed more but yields crept up. In November, the 30-year bond, surprised performer earlier with strong auctions, faced headwinds as supply flooded markets. December saw volatility. Yields on 10-year notes fluctuated around 4.15–4.17%, but longer maturities steepened, signaling term premium rise, extra yield for holding long bonds. Parallel, the data center boom strained resources. AI capex from big tech hit $400 billion in 2025, driving data center deals to $61 billion record. But power shortages emerged. Grids couldn't keep pace. In Virginia, home to 70% of global data centers, demand projected to double by 2030, risking blackouts. Utilities warned of delays, new plants take years. Water cooling raised environmental concerns. By December, panic set in, projects stalled, costs soared, investors questioned AI returns if power limited. Hidden factors amplified the crisis. First, fiscal dominance, deficits forced Treasury issuance, crowding out private borrowing, pushing yields higher. Second, AI hype, valuations assumed infinite scaling, but physical limits, power, chips, land bit, memory shortages from AI demand raised costs. Third, global de-dollarization, nations reduced Treasury holdings, increasing supply pressure. Global implications are severe. Higher yields raise mortgage rates, slowing housing, corporate borrowing costs rise, curbing investment. Stock bubble, S&P up 20% on AI vulnerable to rate spikes. Data center panic delays AI progress, affecting productivity gains expected to add trillions to GDP. Power shortages hit consumers with higher bills, exacerbating inequality. Internationally, U.S. higher rates attract capital, strengthening dollar, hurting emerging markets. In this thoughtful conclusion, the reckoning reveals the perils of prolonged stimulus and unchecked optimism. Collapsing bonds, prices falling, yields rising signal end to cheap money era, threatening to pop the bubble built on it. Data center panic exposes AI's physical constraints, grounding hype in reality. The U.S. faces a pivot, fiscal restraint, grid investment, balanced growth. History shows bubbles burst, but recoveries follow with reform. As 2025 ends, the reckoning calls for prudence, sustainable innovation, responsible borrowing, equitable energy transition. The bubble may pop, but from correction comes renewal if lessons are heeded. As December 23, 2025 brings the year to its conclusion, the pressures on U.S. Treasury bond markets have intensified, with yields on longer duration securities continuing their upward trajectory amid persistent concerns over fiscal sustainability and the structural demands of the artificial intelligence buildout. The 10-year Treasury yield, a benchmark for global borrowing costs, closed the week near 4.35%, reflecting a steady climb from earlier lows and signaling investor demands for higher compensation to hold U.S. debt. This movement in yields, equivalent to falling bond prices, has amplified fears that the prolonged period of ultra-low interest rates, which inflated asset values across equities, real estate, and technology sectors, is giving way to a more constrained financial environment. Concurrently, the data center sector, the physical backbone of the AI revolution, has entered a phase of acute strain, with utilities issuing formal warnings of capacity shortfalls, project delays stretching into years, and industry leaders acknowledging that power availability, not computing hardware, has become the primary bottleneck. This convergence marks the arrival of a long-anticipated reckoning, where financial and physical limits expose the vulnerabilities of an economy built on abundant cheap capital and unbounded technological optimism. To appreciate the depth of this moment, consider the interconnected mechanics of bond markets and the extraordinary resource requirements of modern computing infrastructure. Treasury bonds function as the cornerstone of global finance. When the U.S. government runs deficits, spending more than it collects in revenue, it issues these bonds to bridge the gap. Investors purchase them, lending money to the government in exchange for promised interest and principal repayment. Yields rise when demand weakens relative to supply, often because buyers anticipate inflation eroding returns or worry about the growing debt burden relative to economic output. The debt-to-GDP ratio, a measure of indebtedness, now exceeds 130%, a level historically associated with higher borrowing costs in other nations. Data centers, meanwhile, represent the material manifestation of digital services. A single hyperscale facility can house hundreds of thousands of servers, each drawing power continuously. Cooling systems necessary to prevent overheating can consume as much electricity as the servers themselves. The surge in generative AI has multiplied these demands exponentially, training a single large LAN. Gauge model can require energy equivalent to thousands of households over months, and inference, real-time use scales with user growth. Global data center electricity consumption, already 2 to 3% of worldwide usage, is projected to double or triple by 2030, concentrated in regions like Northern Virginia, Ireland, and Singapore that offer tax incentives and connectivity. The trajectory through 2025 has revealed these pressures incrementally yet relentlessly. Early in the year, bond markets exhibited relative calm, with yields declining as inflation moderated and the Federal Reserve signaled rate cuts. Strong auctions where treasuries are sold to investors absorbed record issuance volumes, supported by domestic demand from money managers and foreign central banks. Data center announcements dominated headlines. Microsoft, Amazon, Google, and Meta committed over $300 billion collectively to new capacity, driving land acquisitions, construction booms, and supplier contracts. Power purchase agreements with utilities seemed sufficient, and nuclear revival talks, small modular reactors for dedicated supply, generated optimism. By midsummer, cracks appeared. Fiscal projections worsened. Tax receipts lagged amid slower growth in certain sectors, while spending on entitlements, defense, and interest payments accelerated. The debt ceiling debate, resolved only after brinkmanship, reminded markets of political risks. Foreign holdings of treasuries stagnated, with some nations subtly diversifying reserves. Yields began a gradual ascent, with the 30-year bond crossing 4.5% by September, steepening the yield curve, a pattern where long-term rates rise faster than short-term, often preceding economic slowdowns. The autumn brought sharper movements. Tariff implementations and policy uncertainty under the new administration contributed to inflation expectations, prompting investors to demand higher term premiums. Weak auctions in November, where bids barely covered offerings, signaled shifting sentiment. By December, volatility increased. Daily yield swings of 10 to 15 basis points became common, unsettling mortgage markets and corporate borrowing. The inversion of parts of the curve eased, but at the cost of higher overall rates. Simultaneously, the data center expansion confronted physical reality. Utilities in key hubs issued curtailment notices, new connections delayed indefinitely due to transmission constraints. Virginia's Dominion Energy projected that data center demand alone could exceed total state capacity additions planned through 2035. Similar alerts emerged in Oregon, Texas, and Ireland. Water usage for cooling drew scrutiny amid droughts, while local communities resisted new facilities over noise and environmental impact. Costs escalated. Power contracts now command premiums of 50 to 100% over standard rates, eroding projected returns on AI investments. Less discussed factors have accelerated the convergence. The AI capex cycle, while driving short-term growth, has crowded out other borrowing. Corporate bond issuance slowed as investors prioritized treasuries for safety. Memory and power component shortages, HBM chips, transformers added delays. Regulatory hurdles lengthened timelines. Environmental reviews, once perfunctory, now span years. Global energy transitions complicate supply. Renewable intermittency requires backup generation, often natural gas facing its own constraints. Another underexamined element is the feedback loop. Higher yields increase debt servicing costs, interest payments now over $1 trillion annually, widening deficits and necessitating more issuance, further pressuring yields. Data center power demands, if unmet, could cap AI progress, disappointing investors and triggering equity corrections that reduce tax revenues, exacerbating fiscal strain. Global implications are far-reaching and multifaceted. Higher U.S. yields attract capital inflows, strengthening the dollar and pressuring export competitiveness while importing deflation from abroad. Emerging markets face currency depreciation and debt crises as borrowing costs rise. European and Japanese bonds with negative or low yields for years experience contagion, complicating their monetary policies. Energy markets tighten. Curtailed data center growth slows AI-driven efficiency gains in other sectors, while power shortages raise electricity prices broadly. For societies, the reckoning carries distributional consequences. Asset owners concentrated among wealthier cohorts face valuation declines, while wage earners confront higher borrowing costs for homes and cars. Regional disparities widen. Tech-heavy states benefit from AI concentration short-term but risk busts. Energy-producing areas gain from demand but strain infrastructure. Environmentally, the crisis highlights trade-offs. Delayed data centers slow carbon-intensive computing growth, yet reliance on fossil backups undermines decarbonization. Water stress in cooling. Dependent regions exacerbate scarcity. In this extended reflection, as 2025 concludes, The collapsing bond market dynamics and emerging data center panic together signal the exhaustion of an economic model premised on perpetual low rates and frictionless scaling. The bubble, inflated by extraordinary monetary accommodation and technological promise, encounters the immovable constraints of fiscal arithmetic and physical resources. Yields rising not dramatically but persistently reflect a market repricing risk, while power shortages ground abstract projections in concrete limits. This reckoning need not spell catastrophe. Historical parallels, the Volcker era of the early 1980s, when high rates tamed inflation and set the stage for sustained growth, suggest that adjustment, though painful, can restore balance. Policy responses could include fiscal reforms to narrow deficits, accelerated permitting for clean energy and transmission, and targeted industrial policy to prioritize efficient computing. Private innovation, more energy-thrifty AI models, edge computing reducing central demands, offers complementary solutions. Ultimately, the moment calls for calibrated realism, acknowledging that growth has limits, that capital is not infinite, that technological leaps require material foundations. The U.S. economy, resilient through past crises, possesses tools, ingenuity, institutions, resources to navigate this transition. As bonds reprice and data centers confront reality, the reckoning invites renewal, a shift towards sustainable investment, balanced budgets, and innovation grounded in physical possibility. The bubble's deflation may sting, but from disciplined correction often emerges stronger, more enduring prosperity. The year ends not in collapse but in confrontation with truth, a necessary step toward adaptation in an era of profound change. As December 23, 2025 concludes a year of mounting financial and infrastructural strains, the dynamics in U.S. Treasury bond markets and the data center sector have reached a point of unmistakable tension, with yields on benchmark securities continuing to reflect investor caution and utilities across key regions issuing increasingly urgent alerts about power supply constraints. The 10-year Treasury yield has stabilized near 4.4% in recent trading sessions, while longer maturities have seen more pronounced upward adjustments, incorporating a higher term premium that compensates for perceived risks over extended horizons. This environment of rising borrowing costs has prompted renewed scrutiny of the asset valuations built during the era of accommodative monetary policy, suggesting that the conditions supporting broad market elevations may be undergoing a fundamental reassessment. Simultaneously, the data center industry, central to the deployment of artificial intelligence at scale, has confronted operational realities that challenge the assumptions of limitless expansion, with major projects facing multi-year delays due to electricity availability and transmission bottlenecks. This dual pressure represents the core of the current reckoning, a financial market recalibration intersecting with physical resource limits, testing the resilience of an economic model that has relied on abundant capital and technological momentum. To fully contextualize these converging challenges, it is essential to examine the interplay between bond market signals and the material demands of digital infrastructure. Bond yields serve as a barometer for broader economic expectations. When they rise persistently, they increase the cost of capital across the economy, affecting everything from government financing to corporate investment and household mortgages. The U.S. Treasury market, the deepest and most liquid in the world, sets the baseline for risk-free rates globally. Recent movements have been driven not by dramatic spikes but by a steady accumulation of concerns. Ongoing fiscal deficits requiring substantial issuance, lingering inflationary pressures in services and shelter costs, and questions about the pace at which the Federal Reserve can normalize policy without disrupting growth. Data centers, on the other hand, embody the translation of digital innovation into physical form. A modern hyperscale facility can draw hundreds of megawatts continuously, comparable to the needs of a medium-sized city, distributed across computing, storage, networking, and environmental controls. The generative AI wave has amplified this exponentially. Model training runs can consume gigawatt-hours over weeks, while inference scales with adoption. Global capacity has grown rapidly, but concentration in favorable jurisdictions has created localized stress points. Transmission infrastructure built for gradual demand growth now faces requests for connections that exceed decades of planned additions. The progression through the latter half of 2025 has illuminated these strains with increasing clarity. Bond Octio. NS throughout the fall absorbed record volumes, but with gradually widening concessions, higher yields accepted to clear supply. Domestic institutions, including banks and pension funds, increased holdings, offsetting slower foreign participation. The yield curve, after years of inversion signaling caution, began to steepen normally, yet at elevated levels that raised servicing costs on the national debt. Interest payments, already the fastest-growing budget category, approached 20% of federal revenue by December projections. In the data center realm, announcements shifted tone. Early year commitments of hundreds of billions in capital expenditure proceeded, but execution encountered friction. Utilities in primary clusters Northern Virginia, Dallas-Fort Worth, Phoenix, and parts of Europe published revised load forecasts showing demand growth rates of 15 to 20% annually through 2030, far outpacing supply additions. Permitting delays for new generation and transmission lines stretched timelines, while interconnection queues, the waiting lists for grid access, ballooned to years. Colocation providers and hyperscalers began incorporating power availability clauses into contracts, prioritizing sites with secured supply over optimal latency or cost. Less examined elements have contributed significantly to the intensity. The AI investment cycle has exhibited classic boom characteristics. Initial overallocation driven by fear of missing out, followed by scrutiny of returns as deployment lags hardware acquisition. Efficiency gains, newer chips requiring less power per computation, have been offset by model scale increases, maintaining or raising net consumption. Regulatory fragmentation compounds delays. State-level approvals for energy projects vary widely, with environmental reviews and local opposition adding unpredictability. Global supply chains for critical components, high-voltage transformers, cooling systems remain constrained post-pandemic, extending lead times. Another underappreciated factor is the international dimension. Higher U.S. yields have drawn capital from abroad, supporting the dollar but pressuring emerging market currencies and debt sustainability. European sovereign yields, long suppressed, have risen in sympathy, complicating the European Central Bank's path. Energy markets reflect dual stresses. Natural gas prices, key for backup generation, fluctuate with demand signals, while renewable integration faces intermittency challenges without sufficient storage. The societal implications extend beyond markets. Higher borrowing costs transmit gradually to consumers. Mortgage rates approaching 7% slow housing turnover, credit card delinquencies rise, and small business lending tightens. Data center constraints, if binding, could temper AI-driven productivity gains anticipated to offset demographic slowdowns. Regional economies tied to tech expansion experience mixed effects. Construction booms provide temporary jobs, but long-term operations employ relatively few, while electricity price increases burden households. Environmentally, the reckoning underscores trade-offs in the green transition. Data centers' carbon footprint, if met with fossil fuels, delays net zero goals, yet curtailed growth slows AI applications in climate modeling and efficiency optimization. Water usage for evaporative cooling competes with agriculture in drought-prone areas. In this comprehensive reflection concluding 2025, the rising bond yields and emerging data center constraints together delineate the boundaries of an extended period of financial and technological exceptionalism. The bubble, manifest in elevated valuations sustained by low rates and speculative narratives, encounters the discipline of higher capital costs and resource scarcity. This is not necessarily catastrophic collapse but a necessary rebalancing, markets repricing risk, investments redirecting toward efficiency, policy confronting trade-offs. Historical analogs offer perspective. The early 1980s bond vigilantes forced fiscal and monetary adjustment, paving the way for prolonged expansion. Today's challenges, while distinct, present similar opportunities for disciplined budgeting, accelerated clean energy deployment, and innovation in compute efficiency. Private sector adaptations, liquid cooling, low-power architectures, distributed edge processing, complement public efforts in grid modernization and permitting reform. Ultimately, the reckoning invites a maturation of the economic model. From leverage-fueled growth to productivity-driven advancement, from abstract scaling to grounded implementation. The United States retains formidable strengths, institutional depth, entrepreneurial capacity, resource endowment to navigate this transition. As yields adjust and power planning intensifies, the moment calls for steady resolve, recognizing limits not as defeat but as the foundation for sustainable progress. The bubble's gradual deflation, managed prudently, can yield a more resilient framework, one where financial stability and technological ambition reinforce rather than undermine each other. The year ends in recalibration, a necessary prelude to renewal in the decade ahead. As December 23, 2025 marks the end of a pivotal year, the interplay between rising U.S. Treasury yields and the escalating constraints on data center expansion has solidified into a defining challenge for the American economy, one that tests the foundations of both financial stability and technological ambition. Yields on the 10-year note have held firm around 4.4% in recent sessions, while the 30-year bond has approached 4.7%, incorporating a term premium that reflects not only current inflation expectations but also long-term uncertainties about debt dynamics and growth prospects. This environment has prompted a broader reassessment of asset valuations elevated during the prolonged period of low interest rates, suggesting a gradual but inexorable shift away from the conditions that sustained widespread market optimism. In parallel, the data center sector has moved deeper into operational crisis management, with major utilities revising forecasts to account for demand that now routinely exceeds planned capacity additions by wide margins, and developers recalibrating project timelines and cost assumptions accordingly. This dual reckoning, financial markets demanding higher compensation for risk, physical infrastructure reaching binding limits, illuminates the boundaries of an era characterized by abundant liquidity and assumptions of seamless scaling. To grasp the significance of these closing developments, consider the precise mechanisms through which bond market signals influence the broader economy and the specific resource bottlenecks now confronting digital infrastructure. When Treasury yields rise, they establish a higher floor for interest rates across the spectrum. Mortgages, corporate bonds, and even consumer loans adjust upward, increasing the cost of borrowing and potentially curbing spending and investment. The current configuration of the yield curve, steepening yet elevated, indicates markets pricing in sustained growth alongside persistent inflation risks, a combination that complicates the Federal Reserve's mandate to achieve both price stability and maximum employment. Data centers, as the enabling layer for cloud services and artificial intelligence, translate abstract computational demand into concrete energy and land requirements. A facility optimized for AI workloads can require power densities several times higher than traditional enterprise centers, with rack-level consumption reaching 100 kilowatts or more. Cooling innovations, air-liquid immersion mitigate heat, but do not eliminate the fundamental electricity need. Transmission networks, designed for incremental residential and industrial growth, now face concentrated loads that strain substations and lines, necessitating upgrades that span years and billions in investment. The final months of 2025 have crystallized these pressures. Bond issuance remained heavy through December, with auctions absorbing supply amid acceptable but not enthusiastic bidding. Domestic buyers, mutual funds, insurers, households stepped in as foreign official holdings plateaued, reflecting diversification trends among reserve managers. Volatility persisted, with intraday yield movements driven by economic data releases and policy commentary. The debt ceiling, suspended temporarily, looms as a future flashpoint, reminding markets of governance risks. In the data center domain, announcements reflected adaptation rather than expansion euphoria. Hyperscalers revised capital guidance downward for 2026, citing power procurement challenges. Utilities in high-demand corridors published integrated resource plans showing reliance on demand response programs, paying large users to curtail during peaks, and accelerated procurement of gas peaker plants as bridge solutions. Nuclear interest intensified, with small modular reactor proposals advancing in regulatory queues, though commercial deployment remains mid-2030s at earliest. Co-location providers began offering power-secured premiums, with contracts commanding 20 to 30% markups for guaranteed supply. Underexamined aspects continue to shape outcomes. The AI efficiency paradox, advances reducing power per computation offset by model complexity and usage growth, has kept net demand rising. Global semiconductor constraints, particularly high-bandwidth memory, limit server deployment even where power exists. Regulatory evolution varies. Some states streamline permitting for clean energy, others impose moratoriums on new connections pending environmental reviews. International parallels emerge. Similar power crunches in Ireland and Singapore prompt policy responses, highlighting universal challenges in digital physical convergence. Another subtle dynamic is the wealth effect reversal. As bond yields rise and equity volatility increases, household balance sheets contract, potentially damping consumption that has supported growth. Corporate leverage built in low-rate years faces refinancing at higher costs, risking defaults in vulnerable sectors. Global repercussions accumulate steadily. Stronger dollar from yield differentials pressures export-oriented economies and commodity prices. Emerging markets navigate capital outflows and debt servicing strains. European bond markets, adjusting to their own fiscal realities, experience sympathetic yield increases. Energy transitions face headwinds. Data center demand accelerates fossil reliance short-term, complicating decarbonization timelines. Societally, the reckoning manifests unevenly. Technology-dependent regions grapple with project slowdowns affecting employment and tax bases. Broader populations confront rising utility bills as costs are socialized. Innovation incentives shift toward efficiency, algorithms requiring less compute, hardware optimized for inference over training. Environmentally, constraints offer unintended benefits. Moderated growth curbs emissions from new facilities, buying time for renewable integration. Water and land pressures prompt sustainable design standards. In this concluding examination of 2025, the persistent rise in bond yields and the deepening data center resource crisis together delineate the contours of a necessary economic maturation. The bubble, sustained by extraordinary policy accommodation and narrative-driven investment, meets the discipline of higher capital costs and material scarcity. This is adjustment, not apocalypse. Markets clearing excesses, priorities realigning toward productivity and sustainability. Precedents inform perspective. Periods of rate normalization, when navigated prudently, have preceded robust expansions grounded in fundamentals. Today's context, enriched by technological potential, offers similar promise if accompanied by strategic action. Fiscal consolidation, even gradual, would ease issuance pressure. Grid modernization, funded publicly and privately, could unlock capacity. Innovation in compute efficiency and energy management remains abundant. The reckoning, then, is less punishment than pivot, from leverage and speculation to investment and resilience. The United States, with its institutional depth and adaptive capacity, is well positioned to emerge stronger, provided leadership embraces realism over denial. As yields settle at new norms and power planning accelerates, the close of 2025 marks not an end but a transition toward an economy where financial prudence and technological progress reinforce one another, yielding growth that is durable rather than illusory. The challenges are real, but so are the opportunities for renewal through disciplined, forward-looking choices.